We talked about the deliveries that we saw in December, which right before the end of the year, which to me is telling the real story. Delivery behavior is telling the real story. And this is not speculative positioning. This is a fight over real inventory. And to me, December really jumped out. 3,706,000 ounces of gold were delivered and 64,730,000 ounces of silver. 64,730,000 ounces of silver were issued and stopped. That means delivered. And a mint box of Silver Eagles weighs 42 pounds. What does 65 million ounces weigh? And who's doing it? But this is every single month. I've been screaming this every single month since a year ago, November. That's the largest December influx in the history of the COMEX market, which goes back to 1974. You know, the long end of the curve, you're talking the 10-year Treasury is the primary instrument by which mortgages and credit cards are written off of, and lease rates and all that. They all come off the 10-year. Well, who wants to give, our money, or who wants to give us money for 10 years at rates that are so absurdly low? I mean, if rates were to normalize to a level that was commensurate for money creation and inflation, this is why they suppress the measurements of inflation. That's why they lie about the CPI. And because if it were true, if we really understood that inflation is closer to 10 or 11%, as John Williams would say, instead of the 3 that we're being told or less, no one would buy things like 10-year treasuries to guarantee a negative real return. So in order for the 10-year treasury to find demand, either rates have to go much higher or, as Judy Shelton says, peg it to gold. Now, if you peg the back end of the Treasury market to gold in an effort to continue to allow the dollar to devalue by letting gold go higher and higher and higher and higher and letting the dollar go lower and lower and lower and lower, then you don't need interest rates much higher at all. You can have virtually zero interest rates on the back end of the bond market, redeemability in gold, but gold's got to go much higher or you're going to end up giving away all your gold. So could it happen? Maybe. Maybe that's part of the plan, but I don't see how you can suppress short-term rates and let long-term rates go higher. That's really where the problem is. It's less the short-term and more the long-term rates that I think they're worried about. We talked about the deliveries that we saw in December, which right before the end of the year, which to me is telling the real story. Delivery behavior is telling the real story. And this is not speculative positioning. This is a fight over real inventory. And to me, December really jumped out. 3,706,000 ounces of gold were delivered and 64,730,000 ounces of silver. 64,730,000 ounces of silver were issued and stopped. That means delivered. And a mint box of Silver Eagles weighs 42 pounds. What does 65 million ounces weigh? And who's doing it? But this is every single month. I've been screaming this every single month since a year ago, November. That's the largest December influx in the history of the COMEX market, which goes back to 1974.
Policymakers face an uncomfortable dilemma. To keep long-term borrowing costs low, they must either suppress rates or restore credibility. Some have floated the idea of linking long-term debt to gold, effectively using gold appreciation to offset low yields. In theory, this allows rates to stay low while the currency weakens. In practice, it risks draining national gold reserves and exposing monetary fragility. Pegging debt to gold is not stability. It is a quiet admission of currency debasement. The deeper issue remains. You cannot suppress short-term rates forever, while long-term rates reflect growing distrust in fiat money.
And January, which is not a major scheduled delivery month, in just the first few days of the month, we've seen pretty damn well near 35 million ounces of silver delivered. 35 million in a non-delivery month within a week of trading. You add that to what we already saw delivered in December, and you're over 100 million ounces of silver that's been delivered in a little over, a month and 5 weeks. And, the That's almost the amount of silver that was mined by just the silver mining companies last year. There was 800 million ounces mined, but the silver miners, according to Rick Rule, only came up or responsible for 17 or 18% of that. So what's that? That's 12, 13 million, 120, 130 million ounces. Well, that was almost completely delivered just in the last month of December and the first 2 weeks, if that, of January. The rest was byproduct mining from the zinc, copper, and lead mines. But my point is that whoever is doing this, they're doing it for a reason. Look, in terms of silver, people need to understand it's a tiny market relative to the capital that can and is flooding into it. And when that happens, the move will be fast, as we're seeing, and disorderly, perhaps as we will really see. And in short, I think it can very quickly cascade on down into the retail market. Now it's starting to get a little bit, it's bubbling in the retail market. It isn't where I think it needs to be. It's not frothy at all. But what you see at the highest level of huge deliveries that are as unusual as a 10-leaf clover, let alone a 4-leaf, I think it will start to trickle down into the retail market where availability becomes very difficult because we're seeing it at the highest level. And at that highest level, those institutional sized bars, well, those are the ones that find their way into refineries that make coins and smaller investable bars. So yeah, it's coming, but not here yet. But it is coming, and you can see it through deliveries that are so far outside the realm of normal that the fact that guys like Jim Cramer and any of the Main Street analysts who supposedly care about the public, the lack of any journalistic integrity is appalling to me. This to me is a much, much more interesting story than the crap that they talk about every day. And yet there's not a word, not even a word that silver's at all-time highs, unless it's, Reuters calling it the devil's metal and stuff. So yeah, it's just appalling to me.
While headlines focus on paper prices, the real signal is found in physical delivery. Recent COMEX data shows extraordinary volumes of gold and silver being demanded and removed, far beyond historical norms. December alone saw record-breaking silver deliveries, followed by massive withdrawals in what is normally a quiet month. This is not speculative trading. It is a scramble for real metal. When contracts that are designed for cash settlement are suddenly forced into physical delivery, stress fractures appear. These delivery patterns suggest a market shifting from paper confidence to physical necessity.
Some caution is always warranted as far as what you're saying about these talking heads, especially after a move like we've seen. When everyone starts talking about something being a certainty, that's when the market will remind us that it doesn't care about your conviction. That said, in the short term, sure, it can pull back. It's a thin market. And after a vertical move, you can see what's called an air pocket or a sharp air pocket. That is a function of profit taking, of margin pressure. We saw margins increase, of headline risk. Yeah, you should sell it. It's at its top, you name it. But look, a $10 or $20 correction in silver is not only possible, it's normal in a market that's moving like this. But it's the underlying conditions that got us here. Tight physical availability, massive delivery demand, in a paper market that is now being asked to settle real-world demand, not make-believe on paper, in real metal that they may not actually have. So yeah, could the metals drop? Of course. And I'd actually be surprised if we don't get some violent pullbacks along the way. But, not trying to sound like a salesman, because I'm not. But in this respect, dips are a gift, because these dips would be driven by positioning limits or positioning and leverage, raising of margins as an example, not by a sudden surplus of metal. So I don't know. I think the bigger issue is it's not, the risk isn't in silver going from 80 to 70 or gold going from 4,600 to 400. The risk is waking up in a market, and you've seen this yourself since you and I have been working together, where you can't get what you want at any reasonable premium or any reasonable price, and the price you thought you'd be able to buy it is gone. And so yeah, short-term caution, absolutely. Long-term conviction, absolutely. In my opinion, both can be true at the same time. You can be cautious short-term, but very much convicted long-term. And that's the proper way to look at it, right? And not be so bullish that you don't see some pitfalls, but be bullish enough to hang on when you get bumped. And because the bull wants to throw you off at every chance, that's for sure.
Silver is not just undervalued, it is structurally small. The total annual supply is tiny compared to the capital pools capable of flooding into it. When institutional demand collides with limited physical availability, price moves become violent and disorderly. Most silver production comes as a byproduct of other mining, meaning supply cannot respond quickly to higher prices. The metal flowing out of vaults today is the same metal used to mint coins and bars tomorrow. Once that pipeline tightens, retail shortages follow. The early warning signs are already visible at the institutional level.
And we just had a client recently who has an awful lot, liquidated 90,000 ounces of silver and 3,900 gold eagles. And we paid him right away. You're talking, it was like, I don't know, $25 million or something. Sure. We can hedge it. We have large lines of credit. We have big bank accounts that we hold specifically for this kind of stuff. And we did. And that's really not the norm these days. But yes, we will always provide a two-way market because we have the ability, for now anyway, until something happens on COMEX, to hedge our exposure to purchases and to sales and to inventory. So yes, that is the idea. We would like to be able to do that. It's the local coin shop that will have a harder time doing that as prices go higher, just for just for ensuring what they have in their store and security and all this stuff that's really getting expensive. The cost of carry is getting expensive. It's getting real. But yes, we have every intention of always providing a two-way market, and we have enough in the way of connections and with refineries and our own ability to melt things down too, where that should never be a problem.
Sharp pullbacks are inevitable in thin markets. Profit-taking, margin hikes, and headline fear can easily trigger sudden drops. A $10, $20 correction in silver would be uncomfortable but normal. The real risk is not volatility, it is unavailability. Markets can reopen after price drops, but they cannot function without supply. The danger is waking up to a market where metal exists only at extreme premiums, or not at all. Short-term caution and long-term conviction are not opposites. They are complementary strategies in a market transitioning from paper abundance to physical scarcity.
I think the reason it happened is because there are some companies that I think are smart, like we were. And I'm not patting myself on the back, but I saw what was happening with the junk. I'll tell you why it happened. And I was watching these junk premiums collapse, and I literally told both operations in Florida and in North Dakota, go into every line of credit you have, and I will provide whatever amount of money that I have as well, and buy up every single ounce you can find in pre-65 silver. I don't care. Turn over every rock, listen to everyone who's calling you, and buy it. And that's the truth. And why? Why did it get so cheap that I could buy it at, as much as $2 under spot at one point? Why? Or even lower. Why did that happen? Because here's how it happens. So that overhang will end quickly, and you'll see premium slingshot on it and catch up. And the reason that happened in my mind is that, so you have half a dozen companies like mine who got this, right? Maybe, us and Money Metals and APMEX and JM, whatever, they figured this out. And so they went and bought everything. But what did they figure out, and how did they figure it out? Not very hard. Here's what happens. We have 3 million ounces of silver in our warehouse right here. I will sell 3 million on COMEX paper. So as one goes up, the other goes down. If I lose $10 an ounce on my 3 million ounces in physical in the warehouse, I make $3 million, or I make $10 an ounce on those 3 million ounces, $30 million on what I sold short on COMEX. Allows me to be market neutral at any given time, right? That's how the COMEX was designed, to hedge exposure and hedge risk. Okay, great. So there you got all these smaller and mid-sized coin companies who don't. I've been doing this for 36 years next month. I know all of the traders. I know all of the refiners. I know all of the major players, and I can very quickly move things around. If you're a small local dealer, you're a small company that really doesn't have the connections. You're working with one wholesaler or whatever it may be.
Behind the scenes, refiners and dealers face immense pressure. Physical metal takes weeks to process, yet price exposure is immediate. As prices rise rapidly, refiners hedging their inventory face relentless margin calls. Many are forced to stop accepting new material just to survive. This creates temporary distortions like collapsing premiums that smart operators recognize as opportunities, not weakness. Once that excess supply clears, premiums rebound violently. The public rarely sees this cycle until it is over. By the time availability tightens, the opportunity has already passed and the market has changed.
When this stuff comes in, and for the last year or two, the demand by the public has been not so strong. Silver goes up to 50 and everyone starts selling this stuff, right? So the coin shops are filled with junk silver and no one's buying it. And so what do? They try and send it into the refiner to get it melted down. Now here's where it gets interesting. Remember what I said about hedging? So you're a refiner, and you're not a big one, or you are a big one. Let's say you're a big one. You have $50 million that you paid for in silver that you bought from the public. You bought candlesticks and flatware. You bought jewelry. You bought junk silver. You even bought doré. You got all this stuff that is in various stages of production. You have to melt it down into shot, which are like BBs. So you got to pull out the impurity and melt it down into little ball bearing size pieces of shot. And then from there, you got to melt that down into your bars and your rounds. And the whole process in various stages can take weeks, right? Well, that $50 million in inventory, you have to hedge it, right? Or you've already paid the money. And what if the price collapses by $50 an ounce down to $30? You're out of business. You just lost millions and millions and millions of dollars. You might as well shut down operations. So they hedge their inventory that they are working to sell. But because it takes several weeks, they're not selling it. They're not rotating their cash fast enough. So what's happened to their short position? As the price moves up by $6, bang, margin call, bang, margin call, bang, margin call. And they're getting margin called to death. And so they're like, oh my God, if we don't put up this money, they're going to close us out. They're gonna liquidate our positions. We're dead. We can't take any more business. We can't take any more business until we clean out this whole supply chain thing. We got stuff in works, yeah, but it's taking too long. And so what's happening is many of the refiners stop taking new orders for the last several months until they clean up their, what they already have in production. And as a result, the big primary distributors or anyone making a market and the stuff was paying under spot for it. And I bought every single penny I could buy, literally, because I saw that very clearly. Now this will change, but it's really because the refiners are getting margin called with their exposure to big allotments of gold and silver that they are working on refining, not moving fast enough. And the margin calls, silver moving up so fast against their short position is creating a very, very big problem for them. That's why I was able to do it. And that's why the companies that bought a bunch figured it out. A little secret sauce of running a company for 36 years that you can see it. And that's just the way the market worked. I didn't set the price, but I took advantage of it. And I sold it to the public for $1 under spot. I didn't screw anybody, of course. I wanted to give that same value that we were able to get and pass it on. So that's why it happened. And it will, once this availability is gone industry-wide, premiums will go right back up. So I wouldn't sell it. I wouldn't, unless I had to. I wouldn't reposition unless I had to, because, by the time this fully flushes through, you'll see much, much higher premiums, if that makes sense.